Good morning, good afternoon, or good evening, depending where you are on the planet, and welcome even to the TGI. Thank God it's Friday, the 22nd of November, Bull versus Bear webinar. Steve Miley here on the call for trade day. Welcome, everyone. Going to go for our usual regular run through it today. It's going to be a fairly brief webinar, not a huge amount going on. We'll run through everything we need to go through, taking a look at the fundamental, macroeconomic, geopolitical, central bank events that are shaping markets right here, right now, and having a quick look at the charts. So first of all, let's have a look at what we've had. A sea of red, unfortunately, in here for European markets this morning on the data side. UK retail sales data, as you can see, red, missing expectations. German GDP, red, missing expectations, worse than expected. We had the global PMI data from S&P Global / HCOB in here. France, lower than expected. Germany just beating on the manufacturing flash PMI, services missing. Eurozone as a whole missing, just meeting, missing. And then also UK data in here, missing. So pretty much missing across the board, apart from one data point in here across the board for the European flash PMI data, German GDP, UK retail sales. So negatives across Europe, raising the chances of then rate cuts in Europe. Rate cuts in Europe equals softer, more dovish policy likely in Europe and potentially UK than in the US. Hence, euro down, pound down, dollar strengthening against those currencies in here, because the US economy holding in better than the European UK economies and overall in here. And so more chances of rate cuts in the Eurozone, in the UK, therefore more dovish ECB, dovish Bank of England, therefore softer, weaker currencies in those countries. You know, kind of counterintuitively as well, though, we're actually seeing European exchanges, and we'll do the run through in a second. But if you look at the European exchange on the overnight, actually FTSE's up, and then little change on the European exchanges, the DAX and the CAC, because of, effectively a more dovish central bank means lower rates, and then lower rates seen as good for the indices, even though that is on the back of the actual economies doing worse than expected. So it's that whole counterintuitive thing we spoke about earlier this week, right? We saw it last Friday on the US retail sales. Bad data, good data. Good data. US retail sales last Friday, better than expected. Markets sold off on that, right? The market sold off because it means that the central bank, the Fed, are likely to be less dovish, less likely to cut interest rates more aggressively, and the market is more focused on the interest rates rather than on the actual data itself. So we're getting this kind of counterintuitive moves in here where poor data, as we've seen this morning out of UK and Europe, being beneficial, and also lower, remember the weaker currencies. A weaker currency is more positive if you're an exporter in those countries, so it's beneficial. A weaker currency is better for the individual companies. So again, that's helping these markets. Okay, European exchanges a little change, but you see the UK up in here. That's because the pound's down. And because of that weaker data and expectation of maybe a more dovish Bank of England pushing the FTSE up this morning. So counterintuitive moves. And we saw it last week on the US retail sales. Bear that in mind when we go into the data that we have later on today. Coming back to here where we have the S&P Global SIPs. The S&P Global flash PMI data. Remember the flash is that it's an early reading, that little P in here, the P that you see after the data for the UK, for all of these, the P for preliminary. So that's the flash part of that data. Flash preliminary even PMI data. So we're getting this early. Remember, this data is for November. We aren't at the end of November, but remember S&P Global released this data when they have, I think it's 80% of remember, it's a survey. The PMI data is a survey of businesses. So when they get most of those surveys in, then they publish this flash PMI based on, I think it's 80% of the surveys that they get in. So you're almost there. There's usually not much of a revision between the flash PMI data and the final PMI data that is usually released on the first of the month. So we're watching those this afternoon, 9:45 Eastern. Keeping an eye out for that, guys, okay? And remember, it could be counterintuitive. A positive number, a number that is better than expected, might be negative for US indices and vice versa. A weaker number could be positive. So maybe counterintuitive moves there. Also, don't forget, later today is often forgotten about, 10 o'clock Eastern time, Michigan consumer expectations and sentiment data. So watching those, that can also have sometimes make a move on the markets. And then late today, but post the close, FOMC member Bowman speaks at 6:15 p.m. This evening in the US Eastern time. But the main focus today on 9:45 S&P Global Services Composite and Manufacturing PMI data, and then the Michigan Consumer Sentiment 15 minutes later at 10 o'clock Eastern. Right, let's run through what we've got going on. Donald Trump pinks Pam Bondi for Attorney General. I don't know if that has any real bearing on the markets. This is the Good Morning America's in here. The morning briefing. I don't think that's got a particularly big, significant impact on the markets, particularly. Treasury Secretary search drags on. Again, Bitcoin back up towards $100,000 in here. Just a number, doesn't really affect us in here. There's nothing really in here of any real note on the overnights. Really, it's just the market moves that we're seeing in here. So if we take a run through, futures dip on caution before business. Well, they dipped and rebounded. This week, I've said all the week, I'm looking for consolidation this week. Okay, we didn't have, the main piece of data was NVIDIA. We looked for consolidation ahead of NVIDIA. We had that, and it was constructive, positive consolidation. So the market's slowly ebbing higher. And this week has been driven by markets dipping and then rebounding, dip, rebound, dip, rebound. We'll take a look at it when we come to the charts, and we've seen that again. Futures dipping lower and then rebounding already. I still think there's a little bit more upside. I think that runs all the way through into next week. Remember, next week, Thanksgiving, Thursday closed, Friday a half day. Markets, there's not a huge amount of data in the first half of the week. I think it's going to be a very, very quiet week of further consolidation throughout next week in here. Dip, rebound with a positive, constructive consolidation tone. That's my outlook. But markets are managing to slowly ebb higher despite geopolitical tensions in here. So gold is up. Markets pushing, the safe haven markets pushing higher on concerns around geopolitical tensions around Russia, Ukraine. So again, in here, if we go through euro, this is then the euro dollar going down to towards parity. Bitcoin up, gold up in here as safe havens. Okay, this morning, euro down versus the dollar, pound also down in here this morning. That's on the back of those data points that we just shared. We just went through in here. Markets in here, we're seeing significantly weaker euro, significantly weaker pound in here, as we have concerns around the European economy, the UK economy, and potential for more dovish central banks. And then UK firms report first contraction since 2023 after budget. That's the PMI data we just looked at for the UK. And then again in here, so all the headlines are a lot of them focused on Eurozone private sector unexpected slips into contraction. Again, that flash PMI data as we spoke about. Euro falls to lowest since 2022. Bets on ECB rate cut surge. Traders see more than a 50% chance of a half-point cut in December, and the currency slides 1% after weak PMI. So across the board in here, the macro fundamentals in here pointing to a weaker euro, a weaker pound, a stronger dollar, and a slowdown in the European UK economies and underperformance relative to the US. US equity is fall, but they've fallen and they've dipped and rebounded. Bitcoin up towards 100,000. Nvidia down again in here and here. So overall in here, we're seeing markets resilient but dipping and rebounding. Gold and oil up, Bitcoin up as well. Safe havens in here. Oil up on concerns of war. Okay, and then again a focus on the euro. Trump's return could extend US stocks dominance over global rivals. We've certainly seen since the election of President-elect Trump in here, we've seen the Trump trade, meaning stocks doing relatively well. We saw the big surge up, obviously, straight after the election, and most stocks have pretty much held on to those gains, kind of sideways over the last week or so, but holding on to those gains, and they've definitely outperformed European and Asian stock indices in here, with obviously a potential more of a inward-looking policy, and also potential negatives on trade from the Trump administration. So anticipation of US stocks outperforming global rivals, not only now but going forward. Okay, obviously for day traders, like a day trader, you're not so much looking at that. But what it does mean is when maybe European exchanges, Asian exchanges are down, doesn't mean you're going to see US follow suit necessarily. So if we do look on the overnights in here, Nikkei's actually up 7/10, but the Hang Seng notably down. Nearly 2% lower on the Hang Seng. European exchanges, as we said, with that negative data in here, the FTSE's actually up, the negative UK data, FTSE up 0.8 and little changed on the German DAX and the French CAC. And if we look at the US futures on the overnights in here, kind of little change there. NASDAQ, I think it's a little bit old because it's like down 0.25%. I think it's only slightly down now. And the S&P 500 only down 0.15% in here. Turning our attention to the rates markets, the interest rate markets in here, this has been hovering between 55 and 65 for a rate cut. So we're getting, it's 60, 40 pretty much in here at the moment, 59, 40, 1. And markets now, very much on a knife edge of whether we're going to get a rate cut from the Fed in December. And as we've been looking at this more recently, now only looking at 40, if you add these two together in here, 50% chance of a one rate cut and maybe a 50% chance of two rate cuts going into March of next year. And then the low point in rates in here, we're looking at 400 to 425 as we go into the summer. So that's only two rate cuts. So the market really just starting to price in now risk of only two rate cuts going into next year, which is actually one rate cut maybe in December and maybe one more rate cut, and then that's it. Going into the summer. And if we actually go run out to the end of the year in here, we're looking at maybe slightly one more rate cut going into the end of the year. So into the third, fourth quarters, with now so three total rate cuts going into the end. So in a year's time, on the rates markets, on the bonds in here, you can see bonds have been quite sideways. Equities, remember, been sideways pretty much in here since we saw the last move to higher yields around the election. Bond markets kind of sideways in here. This is higher, still they're pointing risk to higher yields, so lower prices, higher yields, and we see that on our bond report in here. Markets staying down near lows in here, right the way across the yield curve, 30 years, 10 years in here, 5 years and 2 years, and 2 years actually nudging lower. This is on remember the short end of the yield curve, more aligned with interest rates rather than the economy, so where the Fed is going. And so we're pushing down to lower prices, higher yields in here. So kind of lack of belief that we're going to get a more dovish central bank in here. And we've seen that obviously on the CME Fed Watch tool. On the index side, and we're clinging to an upside bias, and obviously saw a rebound yesterday, and that keeps our positive bias in place for the S&P. Negative, still slightly negative. The slight underperformance from the Nasdaq in here. Rebound still limited, but we could easily turn that around to a more positive. So kind of split in here. There's slightly more negatives from the Nasdaq. So we've got a bearish view in here, but a bullish view in here. But if I go to today, and we've had another dip and a rebound. So here's the ES, right? So all this week I said to look for positive consolidation this week, and we did yesterday actually break above last Friday's high. So we got back above last Friday's high. So we had this significant sell-off last Friday. Since then, up until yesterday, we've been within Friday's range. We did dip slightly below Friday's range and then out of that. So we've had this dip and a rebound, dip and a rebound, dip and a rebound, and then overnight as well, dip and a rebound. Market's pretty much sitting there unchanged going into today. Okay, so we've already had the dip and the rebound, and similar story on the Nasdaq in here. We're not quite back to Friday's high in here, where we had the bigger sell-off on the Nasdaq back on last Friday. We just dipped below the bottom of Friday's range back at the beginning of this week on Tuesday. But again, dip and a rebound, dip and a rebound, dip and a rebound, and again this morning, dip and a rebound. And if we go into the 30-minute chart, this is looking more resilient as we go. So from the sell-off that we saw Thursday, Friday last week, and then this looks like it's a slow base forming, dip and a rebound, higher highs, higher highs, higher highs. Higher highs and higher lows in here. Succession of higher highs, higher lows. I think the risk is that we get a slightly higher high. I don't think this off to the races. That's why I'm caging this around being more of a choppy consolidation, constructive, positive consolidation rather than a bull trend. Similar with that was the Nasdaq. Similar to the ES. Higher high, higher low. Higher high, higher low. Higher high, higher low, and now looking for another higher high going into today. But again, not looking for this to be off to the races on the upside, not a new bull trend, but simply maybe chopping to the upside, more of a positive consolidation, constructive consolidation in more of a range environment going into the end of this week. And I think that carries out into next week as well. So that's the outlook in the very short term. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Wish you all a great weekend too. Until next Monday, I'm going to say as ever, stay safe, take care. Bye.